Hello everyone, my name is Robert Woodward. We are going to be talking a little bit about production today. So I am glad you all were able to attend, and I'm grateful that you all were a little understanding of the weather. We were unfortunately out of the office yesterday, so I'm grateful for those who are attending. Just as a reminder, the webinar is being recorded. It will be posted to our website shortly. In a few days. Normally it's a little faster, but right now it's taking a little bit longer. We have an unfortunate delay. If you have a general question, please go ahead and ask it in the question pane, and we'll go ahead and hit those after my presentation. If it's a specific question to your industry, please reach out to our support team at support@capsim.com or through phone at 877-477-8787. Okay, and I am starting at my dashboard page. So this is what prior to getting into the decision, this is where we're going to start. And just as a reminder, we are using Capstone. If you are a foundation user, the principles apply. Everything's going to be in the same place. It's just a matter of different colors, different number of products allowable, etc. Okay. All right. So we are going to get going. All right. So part of the nice thing about production is you're dependent. Well, you're dependent a little bit upon other departments, but the information that they input will give you a lot of information as to what decisions you should be making. Okay. So I'm going to go ahead and launch the web spreadsheet. Click into production. Let's quickly go over a little bit of what we're seeing. Okay, so production, there's three main sections. Okay, first off, you got the scheduling. Okay, so this is where we see what our forecast is based upon marketing. This is where we see inventory on hand, and this is where we decide how much production to put forth. Okay. Second section, this just gives us some margins based upon our production, based upon the pricing from the marketing area. Okay, so you can see total unit cost, contribution margin, how much of a second shift you're using, and you'll see little information bubbles next to each of these just for a little clarification of what the topic may be referring to. Okay, then there's the physical plan. This is something that where you are deciding if you need extra equipment to produce more in subsequent years, whether you need more automation to try to lower some variable costs and increase your efficiencies. This is your decision. And then a couple other minor things we'll hit on at the end, complement percent and accounts payable. Okay, so with that in mind, it's important that the production manager communicates with the marketing manager. Reason being is you're pretty dependent upon the sales forecast. Okay, so right now I have a sales forecast in for all of my products. Now, if I were to go to marketing, clear out a forecast, instead of having a 0 in there, you're going to see a benchmark number, which in past webinars we have discussed that is not something you ever want to base a forecast on because it doesn't understand the level of competition in the market. So it's important for you to see if those forecasts are accurate. Okay, if they are, that's valuable information for you. Now, I would also communicate or ask them if that is perhaps an actual forecast, if it's an aggressive forecast or a conservative forecast. Okay? We recommend a lot of teams to, in a sense, do a best case and worst case scenario, in which case their forecast is going to be very conservative, which means you're going to need a larger spread between the number that carries over here to your actual production. Okay, so communicate with them what number they have in place. That way you know how to treat it. Okay. Okay, now moving on. For example, we see 2,700 units as a forecast. Assuming that's an actual forecast, you want to make sure that you have at least 2,700 units available in the year. Okay, so your job is to, with your inventory on hand from past production, plus your production, you need to make sure you have at least 2,700. So, for example, I'm going to type in 28. That way, 1628 plus 72 is going to give me 2,700. Okay, that way I'm matching what I need. Okay, so what we see here is a red line. Okay, this indicates that there's an issue that would prevent me from producing that much. So, reason being is I have exceeded what I can produce. I only have 1,200 units of capacity, which, with 2 full shifts, that allows me to do 2,400. So, I can't produce enough based upon the forecast that's in here. So, this is a perfect time to communicate with my marketing team and say, hey, I can't produce this much, okay? And try to figure out ways to, one, avoid as much of a stock out, and to try to maximize your profit margins, okay? Because there's steps that can be taken here, okay? Now, with Acre, if I were to do the same process, 2450, match my production, I'm not going to have an issue with capacity because I have sufficient for my needs. However, when I get here, I notice that my production after adjustment is lower than the 2450. Actually, hold on, let me recalculate. I apologize. Let me recalculate again. Give me one moment. Give me one moment. I will be right back. All right, so 2450, I'm trying to match my forecast, and when I do that, I see that I'm not quite getting 2450. Okay, so this would be a good time to click my information bubble for production after adjustment, and you're going to see various reasons why you're not going to get quite the output you were hoping for. Okay, first, the capacity. That's a scenario that happened with Able. This case is simply relating to payable policy. Okay, so the faster you pay your part deliverers, the more chance you're going to get full output. So, in other words, because I'm paying 15 days after my bills come due, some of my deliveries are a little bit behind, which means my laborers are now, instead of doing the work, they're stuck waiting. So, naturally, I can't get the full output. So, in the case of this, it's important to at least raise my forecast to offset the loss. That way, I'm at least able to maintain or to get my desired needs. Okay? So, in the case where I have inventory, I have a forecast of 1343, I have 106 in inventory. You don't need to produce the 106, you already have it available. So, production after adjustment plus inventory needs to at least equal forecast, the unit sales forecast. Now, when I say at least, the reason why I say that is because if you only match the number that is your forecast, then there's a large risk of stocking out. Okay, and you don't want to stock out on product. It's going to leave you with unhappy customers and missed potential. And I imagine your boss, being the CEO and the board of directors, they're not going to be very happy with you if you're missing out on potential sales, which in turn will be profit margin. Okay, so we recommend that you exceed your unit sales forecast by maybe month's worth of inventory, 10%, somewhere beyond your forecast, but something that's not considered excessive. Okay, a little inventory is better than missing out on sales. Okay, so in other words, if I wanted to exceed my forecast by maybe about a month's worth, or let's just say 10% for simplicity, if I'm looking at my forecast and I need 1343 and I have 106 on hand, that's 1237. So maybe I would make sure I have 10% more above this, which is going to be about an extra 134. So plus, oh, I did something wrong. I apologize. So 1343, I'm just going to add 10% to that. Then I would need 1477, I'd subtract my inventory. And now I would want to at least have 1371 as my production after adjustment number. Okay, so that will help alleviate a lot of the risks of stockouts. Okay, and because you're not changing your forecast, your finance team assumes the 1343. Okay, not the 1477 number that we had. That was the 10% above that. Okay. All right. Now, in some cases, if you have a brand new product, and let me see, I believe this is a brand new product. I know I have 1,200. I can do 1,200 capacity because I have 600 here. Now, you may notice there is a very large spread here between my adjustment and between my schedule. Simple reason for that is because my product isn't available day one of the year because it hasn't finished its R&D process. So you can't produce a product that doesn't actually exist yet. So you're going to lose a portion of that. So make sure that you're aware that, one, you can't sell the product day one, and you can't produce it in day one. Okay? So definitely factor that into a forecast and any production levels you have. Okay? Now, for second shift production, if you are seeing numbers here that are either very high or very low, then it's valuable information. So if you see 100%, I'm maxing out my production, and in this case, I can't quite meet my demand, that's information that should be beneficial for you to make sure that you can take the steps to avoid not being able to meet your production needs next year. And that would come from down here buying capacity. Now, when you buy capacity, you buy it for the next year. Because you purchase equipment, you can't run to the store and buy a production line. It's going to take a year to be built, to be delivered, to be calibrated, and be ready to use. So you purchase a year in advance. So you need to be basing your needs here off of next year's demand. Okay? And you want to avoid getting up to close to 100%. Otherwise, you're putting a lot of risk there. So we recommend not exceeding maybe 80% of your second shift production. Okay, with, of course, next year's demand. Okay, so if next year I thought I was going to sell 3,000 units and I don't want to max out my production, I could buy 300, but that would max out my production because 1,500 times 2 is the 3,000. So instead, I may purchase a little bit more. This way, I would have 3,400 units available for the 3,000 I think I'm going to sell, which gives me a fair bit of wiggle room just in case the 3,000 was conservative, or in case something else happens in the market that would cause my demand to increase. Okay. Now, in the case of I'm leaving a segment or leaving a product, I have no interest in this. My add-in product simply isn't profitable. If that was the case, but I had inventory that was valuable, I would sell all of my equipment except one. The benefit of that is now I'm not going to have any depreciation expense. Okay, I'm getting $17 million back, which I can use to reinvest into something else. And now the product will essentially be discontinued, assuming I sell any inventory off. This way, you can make as much profit for a product that's struggling as possible, okay, and not have as much of the costs associated with it. Now, if you're in a situation with Acre, I have no inventory, I have no interest in my product, I would sell it off completely, and now the product will be gone. The product will cease to exist next year. Atom will still be there, though, because I still have some capacity. So next year, you would then want to go in, sell the remaining unit of capacity, and then it's gone. Okay, so those are kind of the two ways of discontinuing a product. Okay, all right, now automation. Okay, as of right now in the simulation I'm in, I have very, very high automation. Now, you normally don't want to sell automation simply because, one, it costs money to reconfigure your equipment, plus it's going to increase your variable costs. But a couple places to get good information on good automation ratings is back to the Getting Started section in the margin analysis. We give recommendations as to certain, let me look for those numbers, certain recommended automation levels depending upon your segment. Okay, so we got 8s and we got 10 for low tech, and we got lower ones for others simply because they change faster. Okay, so while that affects R&D, which isn't exactly your department, because it affects them, I'd recommend you would want to communicate your plans in terms of automation with them. Okay. Now, going back to my spreadsheet, we'll open it up to questions in just a minute or two. All right, so let me spend some money just so I can get a positive number down here. All right, so what you're given down below is there's a certain amount of money that you are allotted to grow your company. In this case, $91,671,000. Okay, this is the number that my finance department has said this is what we can afford. This is what we can raise through long-term funding. Okay, or in some cases, a little bit of excess working capital if I have lots of cash. So it mentions that in the information bubble, so you could correlate this number with the ability to raise stocks and ability to raise bonds. Now, that whatever number you spend here will carry over to finance, so you don't necessarily have to say, I'm spending this much, we need to finance X amount of dollars, because the information carries over. Okay. Nonetheless, you have the ability, your finance department has pretty much already authorized you to say, this is what we can fund. Okay. You decide to spend that within the constraints you have. If they come back and say, well, we really can't afford it, we have other expenses, then go back to the drawing board. So again, it's another time in which you're going to need, which there's going to be some communication that is going to affect you. All right, complement. Complement is simply your number of employees that you have. So last year I had 465 employees. This year I need 279. Okay. This 100% essentially says I am going to have available the exact number of employees I need. Okay? If I were to change that from 100 to say 90, then I am going to have 90% of the employees that I need, which is going to require some employees to work some overtime. Okay? Now typically your employees are not going to be very happy when you tell them I need you to work overtime or you're going to work overtime. Okay? So plus, there's going to be the time and a half of overtime on your first shift, and then probably a little bit on your second shift. You know, a time and a half on a second shift, that's going to be significantly more expensive than normal. Okay, so occasionally you may find a situation in which having a bit of overtime could be advantageous, but typically it's going to increase your variable cost. Okay, it's going to disappoint a few of your employees, which may cause their productivity to go down or your turnover rate to go up. So you're going to want to be aware of the effects on your financials and on that. Okay, and then your accounts payable. This is something that you can affect, it is a financial function, but it will affect your production after adjustment. So if I were to go back to the default of 30, instead of missing out on 1 unit here for my aft product, I'm going to be missing out on 12. Okay, which of course means I'm still paying my employees to do the 1220. I'm just getting less output. So be aware of that. Okay. Let me take a look here. Okay, let's go ahead and open it up to questions, and then if I have any other comments towards the end, we can go ahead and hit that. Okay, so just a little bit of a clarification on the selling off of an equipment. Okay, the advantage, or I guess the reason behind keeping 1 unit of capacity versus selling all of it is simply if your inventory has value. If you sell it all off, then you then essentially you are scrapping the total amount, the 106. So you're getting it for half the cost of what you already produced it for. So you're taking a huge hit. So if you think you can sell it instead, sell it, I imagine, for a profit, that's where you would keep the 1 unit of capacity for the 1 year and then sell it the remaining year. Okay, so it depends upon the situation, but both of those are good ways to essentially get out of a production line. Okay, give me one moment while I read the next question. Okay, so question by Shelley regarding those recommended automation levels. Question is, would you ever go higher in automation? You can. And in some cases, it may be beneficial. Now, of course, it's going to affect your R&D process. If your automation prevents you from keeping your products viable, keeping your revisions from occurring within the calendar year, then it could be a problem if either of those occur. Okay. If you can increase it, still do your R&Ds. It doesn't hinder your product design at all. Of course, your product may come out a little bit later, so you're going to have a little bit more R&D cost. It can be advantageous. Just beware to maybe not go all the way to 10 on the high tech, simply because it's going to have a significant impact on your sorry, I just lost my train of thought, on your ability to keep your products designed properly. Okay, all right, Bridget, what's the best method of funding to increase your automation? Okay, similar with automation and capacity, it's important to do it with the form of long-term funding. Okay, now we're going to cover this in detail on the finance one that we're going to be doing on Thursday. But if you spend $50 million to grow your company through your investments, it's usually a good idea to do long-term funding to fund that $50 million. Okay, and that's pretty much. So you are not responsible or trying to run your improvements off of any operations or off of any current assets. Okay. All right. Couple more questions. Let me just read it. You mentioned it's not good to run your second shift at 100%. Why not? When you're running your equipment at 100% second shift, in other words, what it's saying is, while it's not a problem per se, you put yourself in a difficult situation to not be able to meet your demand. So usually if you're at 100%, then maybe you're not quite able to produce as much as you would want, but you can kind of meet your demand. In other words, it's kind of saying you didn't really plan well ahead. You didn't give yourself much margin for error. Okay, and with anything, you want to give yourself a margin of error. It's going to alleviate a lot of the risks of you performing well at your job. Okay, so which is why you may not want to exceed 80 or so percent on the second shift, because you plan on the 80%, and then if you need a little bit more, then you have the wiggle room. If you plan on the 100%, and say something happens in the market and your demand goes up significantly, then you're going to have a problem with not being able to meet your demand. Okay. All right. Question by Scott, and I'm going to cover this in a minute. So Scott, I'll come back to this. It's about the recording of the webinar. Okay. Couple questions. Actually, a couple more. Let's see. All right. At what point should I buy or sell capacity? Okay. When you're buying capacity, you buy it for next year's demand. Okay, so you're going to may need to communicate with your marketing team to have them think about what we may sell next year, and then you make sure that you are able to meet the demand there. Okay, if you're selling an asset, you may want to think a little bit further out. Reason being is, if for Able, I have 1,200 right now, or sorry, 7. Actually, let's see. Yeah, 1,200 right now. If I were to sell 700, because I don't think I'm going to need it, that gives me the ability to do 500 per shift. Now, say next year I end up needing more than 1,000, I won't have it. Okay, because I could repurchase it next year, but that would take another year to come in to buy the new equipment. So it's recommended you at least do 2 or 3 years ahead when you sell an asset. So figure out what you're going to need. If you deem you have excess, then go ahead and get rid of it. Now, if you're in the case where you have tons of inventory and you're not going to need to produce in year one, you may not want to sell it all off, because once you sell the inventory, then you're stuck with no equipment and no inventory because you already sold it off. So again, you're going to need to be thinking a few years ahead in some cases to make sure that you can meet the demand for your product. All right, let's see if there's any other questions. Okay, quick question, and maybe something that needs a little clarification. How do you decide it's time to sell capacity? For example, say I have my Able product. Okay, I have 1,800 units of capacity. That gives me the ability to do 3,600 units in a full year with both of my shifts. Okay, say I last year sold 1,500. Okay, I don't anticipate a lot of change in the market, and my demand is going to go up by, say, 10%. That means 1 year in the future, that's about 1,650, then maybe 1,850, and then maybe 2,250, assuming roughly a 10% growth in 3 consecutive years. Okay, I have the ability to do 3,600. My demand with growth in the market assumes about no more than about 2,200 to 2,500, even if I was very aggressive in my forecast. That's a good situation in which case you have more than what you need. So sell off the asset, reinvest it into something that is going to benefit you. Okay? Just because you're going to need an asset eventually doesn't mean you hold on to it, because it depreciates. Okay? And you're losing value on that asset by not using it. Okay? All right, let's see. Okay. Quick question. One more question, and then we'll close. What is the unit sales forecast based off of? Okay, the unit sales forecast is based upon your marketing's assumption of what you're going to sell. Or, as I mentioned earlier, if there is no forecast in place, it's going to use the benchmark prediction. So communicate, or even with them, or even go back to your marketing page and see if there's an actual forecast in there. So in the case of Adam, there's no forecast. Okay, so if I were to go to, lost my train of thought, back to production, then benchmark is factored in there. Okay, so you want to keep that in mind as you want to make sure you have an accurate forecast. Okay, all right, if any more questions do come in, reach out to our support team, 877-477-8787, or through support@capsim.com. Now, the webinar has been recorded, and it will be posted to our website. Normally, we're good for about a 24-hour period. As I said, unfortunately, we have a little bit of a delay with getting those up there. However, it will be available if you all need to see it. Okay, so if you need one of these recordings, and I think it goes for even the ones last week, if you need the links to those, I can send those to you. Okay, so reach out, and that's something you can do at support team. Just say, Robert said the recordings are available. Could I get the links? Okay, but we'll get those posted in a few days. But where they normally would be posted, capsim.com, events. Scroll down below the image, you're going to see webinars. Webinars, student webinars, and you got the links for the recordings. Okay, so click on them, you get a pop-up video, and you can watch the video. Okay, and they'll be hosted there at least till the end of the semester, until we record new webinars in the summer. Okay, all right. Well, I appreciate you all attending and for participating. A lot of good questions. And good luck. And if there are any other questions or again, reach out to our support team, or you can go to the online guide, which is going to be under the help menu in the simulation. All right, everyone, take care and have a good day. Bye-bye.